Okay, so today we're going to be diving into a financial challenge that does not get talked about enough, and that's why so many high income earners still struggle with debt. So even if you're earning six figures or more, carrying multiple loans, credit cards, car payments, and mortgage costs, all of that can feel so overwhelming. And with today's interest rates, so many people are paying far more than they need to without ever having to realize it. So I see this all the time when I'm doing refinances for folks. And so I thought I would do this video where I'll walk you through a realistic scenario that I see all of the time. And this is going to be a fictitious couple. This is not a real couple, but we're going to use Lisa and Mark here. And their story reflects what I do to help people every day when they're consolidating debts. So what we're able to do in this situation is we're able to refinance their mortgage, and they're able to lower their monthly payments, and they were able to save significantly in interest costs, and they're able to do a number of different things like improve their credit rating and all that kind of stuff. So I'm going to break it down for you, and we'll see if this can work for you as well. So let's just jump right into the scenario, and we'll take a look at Lisa and Mark's, our fictional couples, real world financial challenges. So let's start off with what's happening. So first of all, they're juggling multiple high interest debts. And that means they're making several payments each month to different lenders, all at different interest rates. And what is the problem there? Well, a lot of their stuff is maxed out. So their credit utilization was over 90%, which means that's going to have a significant impact on their credit score, and it's going to lower their credit score. The other thing is they have, like a lot of people, they use these never plans at furniture places. So they've got this huge payment that's due for furniture they bought a couple years ago, and that was no payment, and now that's due in a couple months. On top of that, they're overwhelmed by all the different bills. They're struggling to make sure that they're hitting their due dates. And unfortunately, most of the stuff that they're paying for is interest only. They're not actually putting a dent in their debt. And so, of course, they're really worried about the mortgage renewal coming up. They know that a lower credit score could definitely impact their credit rating that they're going to get. And in the end, they're struggling because they're not really saving for their retirement. They're not really enjoying their lifestyle the way they want to. And of course, they're carrying a lot of stress. So what we want to do is I want to run this through my Refinance Analyzer. This is a mortgage app that I have that enables me to run the numbers and see if it makes sense. Because in the end, I'm definitely not going to do a refinance for somebody if it doesn't make sense. Okay, so let's go through the situation. So they own a house. It's worth about $1 million. And they've got a $500,000 mortgage on it. That mortgage is at a 5.25% fixed rate. It was a 3-year fixed, and it's coming up for renewal in about a year and a half. Okay, they've got a secured line of credit, so that's a home equity line of credit, and the balance on that $60,000, and they haven't made a big dent on that over 2 years. They also have 2 credit cards. One of them's at $25,000. That's at 19.99% interest rate. And they have another one that's $15,000, and that one's at a 22.99% interest rate. They also have an unsecured line of credit for $75,000. Yes, $75,000, paying a huge interest on that, 10.99%. And that they're just making interest-only payments on. They also have that furniture loan that I talked about. That's $6,000. That's due in a couple months. And of course, they have 2 car loans. In this situation, the one has got $12,000 left as a balance, and the other one's about $6,400, and that totals almost $1,100 in monthly payments just in cars. Okay, and finally, Lisa has a student loan of $18,000 that she's trying to take a dent off and pay off. However, she's not in a financial situation to do it. So altogether, if we add up all of their debt payments before refinancing, we're talking about almost $7,000 per month. That's a huge financial burden for them. So let's see what happens if we consolidate a lot of that debt into their mortgage. We'll look at a variable rate right now. We are in a rate decline environment. And so we use 4.7 as a variable rate. So here we are now. I'm going to jump into my app, as you can see on the screen. And we want to look at all of the different debt, and we want to see how we can consolidate that into a mortgage. But first, we have to add everything in. So the first thing we're going to do is we're going to go in and add in all their mortgage information. So you can see on the screen here, we've got their current mortgage situation, their current interest rate, their current monthly payment, All that's included in the app right now. Okay, so now that we have all their debt in the system, we have a mortgage that we're going to refinance. Now we want to look at what is that impact going to be. And so we'll first talk about interest, the interest savings, because that's going to be a pretty big financial impact. So before refinancing, Lisa and Mark were paying over $51,000 in interest across all their debt. After refinancing, as you can see from the screen here, their total interest has dropped to $36,000. Okay, now let's talk about the cost. So anytime you break a mortgage, there's a prepayment penalty for that, okay? And if you're in a variable rate mortgage, it's typically just 3 months interest. But if you're in a fixed rate mortgage like they are, there's going to be an interest rate differential penalty. Luckily, we're in an environment where the penalty's not as substantial because the interest rates are high now as well. So if we look at the total cost of this, the prepayment penalty, the legal fees, and to do the appraisal on that, you're talking roughly about $13,407, which we could potentially roll some of that into the mortgage as well. So if we look at their total interest savings over time, they're going to save approximately about $15,000 this year just in interest. So that's money that would have gone straight to the banks, but now they get to keep that. So how much did their monthly payments change? Because that was the big problem that they have. Let's compare it. So before refinancing, they were paying approximately $7,000 a month, and that's across all of their debt obligations. But then after refinancing, their new monthly mortgage payment is just $4,107 per month. So we freed up $2,923 per month for them. So that means now they have an additional $35,000 per year that they can put towards their future or use to pay down that mortgage. But now they have some breathing room. So not only did they save on interest, but they also paid off that high interest credit cards. They consolidated all of their loans into a single lower rate, and they eliminated all those multiple bills and all the due dates. So the biggest thing for them is they've reduced a lot of their stress. So that's basically the power of restructuring your debt, doing a refinance and consolidating everything. You really can free up your monthly payments. You can improve your credit rating because of that, because they've eliminated that utilization rate, and they've given themselves some breathing room. One of the things I check when I'm helping my clients refinance is their break-even point. So how long does it take them to recover the costs of refinancing and start seeing some real savings? So for Lisa and Mark, the break-even point is just 12 months. And you can see that on the screen here. And that means in just 1 year, they're going to have fully recovered the cost of the refinance. And every dollar saved after that is pure financial gain. So think about it. One decision today for them can completely change the next 25 years of payments. All right, so let's just sum it up. The goal at the end was to see whether or not a refinance and consolidating debt would help Lisa and Mark improve their financial situation. So what did we do? Well, we consolidated all their high interest debt into a simple mortgage at 4.7%. That significantly lowered their interest costs. They also rolled their prepayment penalty into that mortgage, so they didn't have to come up with that huge cost of $9,000 to break it. They lowered their monthly payments by almost $3,000, freeing up $3,000 per month. And that significantly improved their financial situation and allowed them to breathe month to month. And most importantly, they simplified their finances. So they improved their credit score. They took back control of their financial future. So hopefully you found this helpful. If you're in a situation like that and you want to do a refinance analysis and see if it makes sense to break your mortgage, roll all of your debt into your mortgage, and get yourself into a financial situation that give you some breathing room, reach out, DM me, and I don't sign anyone to contracts. I do this for free. Typically, the lenders will pay me. You don't have to pay me. Okay? Bye for now.